Okay. So hi, everybody. This is Abara Koye, Chief Cook and Bottle Washer of the Wealth Building CPA. We are going to be talking about some tax saving strategies today and also looking at insurance and then just different announcements that I have to make. So the first thing, I have a couple of announcements. If this applies to you and you're able to assist, you can either send me an email or send me a private message here. Do we have any realtors here that offer flat fee MLS? Okay. Any takers? Anyone that offers flat fee MLS listings? Does everybody know what a flat fee MLS listing is? Okay, so Ashish is saying that he does not, but he can work with us. So Lori, I guess you can see that on the chat and reach out to him. Okay, some people don't know what a flat fee MLS listing is. Can somebody educate us on what a flat fee MLS is? Okay, so a flat fee MLS listing, we know that most realtors get paid a percentage of their they get a percentage of the sales price. That's the commission that they earn for helping out with real estate. However, the flat fee MLS listing, instead of paying a commission, you just focus on getting the listing into the MLS, and you just pay the realtor just a flat fee to get that done. They handle the buyer or the seller. The seller handles everything themselves, but it's just being able to get it into the MLS. So that's why it's called a flat fee. They'll charge anywhere from 200 to 500. I don't know, what the range is, but they get that listed into the MLS. You handle all the phone calls, you handle the signage, you handle the lockbox, everything. So sometimes that's an inexpensive way to also get your property sold, because if it's in the MLS and everybody is seeing it, right, you have the exposure. But if you're trying to cut down on costs without necessarily using a realtor, you can do that. There are advantages of working with realtors, so this is not in any way implying that you should not work with a realtor. We just have some clients that were looking for people who handled flat fee MLS. Okay. I have another client that's looking for a property here. So she says she's looking for a 2 to 4 unit in the DMV area in the $300,000 price range, willing to do some work, but doesn't want to do a total gut rehab. So if you guys know anything or know any wholesaler that has a 2 to 4 unit in the DMV area, feel free to let us know as well. Okay. All right. Okay, Eddie. What I'm gonna do, let me put my email address here, so you can email me that information, and then I will send it across to my client that's looking. Let me actually pull it from here. Marcy, give me a second. Eddie, also put your email and phone number there so that I can get that across to her. All right, since it looks like we're doing some pitches here, does anybody have any other pitch? I guess I'm being generous today. Does anybody have any deal, any business, whatever it is that you're doing, we want to pitch. We'll take only 2 and then we'll get started. Eddie, if she buys from you, I want you to see me. I need my money. Okay, I'm sending it to her. I'm also going to copy you on it, Eddie, so that. All right, anybody have any business to pitch, any property, anything you want to talk about before we get started? Okay, so let's start looking at some year-end strategies. First thing that I want to ask, I know the market has been crazy lately. Is anybody having to hold on to a property much longer than they anticipated? Do we need to talk about the tax impact of that? Did anybody end up selling a property less than they had thought they would sell it for? Do we want to look at the tax impact of that? Did anybody make more money than they thought that they would make? You know, do we need to look at the tax impact of that? So you guys let me know which of these 3 you want to talk about or discuss. Everybody's quiet today.
I have a question, but it doesn't pertain to what you were talking about.
Okay.
So, as you know, I have a property that is under my name. I wanted to get it out, get it in the LLC sooner than later.
Mhm.
I've already got the LLC set up, but I don't know the tax strategy, or is it a good idea? I know it's a good idea as far as asset protection, but what can I expect as far as taxes?
Okay, great question. So yes, I actually consulted with 2 clients today on this. The tax attributes of a buy and hold property does not change whether you have it in an LLC or not. It's still going to be a passive investment, whether you have it in your name or in the LLC name. In terms of what happens on taxes, the main thing is that if you have passive losses, meaning that the expenses including depreciation is a lot more than the income. If you make over $150,000 a year, then those losses are going to be limited. The only time that you can claim those losses if you make over $150,000 is that you need to be a real estate professional. There are 2 main requirements for being a real estate professional. One, you need to spend more time in real estate than in any other active profession. So if you have a regular job, 40 hours a week, that's like 2080 hours. 2080 hours plus 1, you need to spend at least 2081 hours in real estate in order to claim that loss. And more time in real estate than in and 750 hours in real estate, which is at least 14 hours a week. There are some people, we know that you're doing that, but your job doesn't know you're doing that, and the IRS has caught on to it. So what's the IRS has been doing was people that are able to meet that real estate professional requirement, what the IRS has been doing is that if you get audited, they end up requiring your job to certify that you're not working, 40 hours a week. And who wants to go and let their job know, hey, you pay me for 40 hours, but I'm only doing 25 hours. And so because of that, I'm doing 30 hours in real estate. And so you end up losing that tax benefit. So it's just to keep that in mind, that even though you may meet that real estate professional status, if you're hired to work full-time and that's what your employment contract is, the IRS is now requiring a certification from your employer that you only need to put in 25 hours. And they know that most people will not want to go to the employer on that. So if you don't meet the real estate professional status, then whatever losses you have are suspended. You don't lose it. It's just suspended until you start generating active income, or you come under the 150 limit, or you sell the property. So those are things to kind of keep in mind if you are thinking of transferring your property to an LLC, or you just have a buy and hold property. This means that if you make over $150,000, tax benefits should not be the reason why you are investing in real estate. You should be looking at it from other wealth building strategies. You're looking at your principal pay down, you're looking at your appreciation, and then you're looking at whether or not you're invested in an equity property or a cash flowing property. There's got to be other reasons beyond the tax benefits for doing real estate. Okay. All right, so Cree said, I transfer the property from one company to another, though members are the same. Do I have to wait a year from the transfer to be long-term? No, you don't have to wait. If it's the same members, then you get a carryover basis and carryover holding period. Okay. Wholesaling and rentals consider real estate professional, or is that just realtors? Rentals is what I just described. That's long-term buy and hold. So if you're doing it together and that's all you have, you don't have a regular job, then yes, your wholesale and business could qualify you as a real estate professional, and therefore your rentals end up being part of that. But if all you're doing is wholesaling, or if all you're doing is rentals, then you do need to make sure that you're meeting that 15 hours a week, 750-hour requirement, and more time in real estate than in any other profession. So wholesalers, rehabbers, realtors could meet that requirement if that's all you're doing. But if you have a regular job, and in addition, you're wholesaling and doing all these other things, you do need to do the calculations to make sure that you're spending more time in real estate than in the other job that you have. Okay. All right, so Kessonet said, sold her house and made money, but I had the house over 6 years. So how is this tax applied now? I need to know whether or not, is it your primary residence or is it your rent? Well, let me talk about both. If it's your primary residence and you sold your house and made money, this would be the time, year end, to start calculating what the capital gains is on that property. As we're talking, I am going to see if I can pull up a sample capital gains worksheet so we can go through how to calculate the numbers. But you need to make sure that make sure that you calculate what that capital gains is. Now, if this is a property that you were holding where it was a rental, you need to be aware that you have to recapture depreciation. This is something that a lot of people end up making a mistake on, because they don't realize that the depreciation that they've claimed over the years now needs to be picked up, and that's going to impact what kind of capital gains you have. So it's very possible that all you got at closing is $30,000, but you end up having a $60,000 capital gain. If you refinance at any point in time that you owned the property, you are going to have capital gains. You may only get $20,000 at closing, but because the refinance proceeds at the time that you got it was not a taxable event, you are now going to have more in capital gains, because that loan that was paid off at closing is not taken into account in calculating what your capital gains is. Now, if this is your primary residence and you lived in it for at least 2 out of 5 years, you are able to get a $250,000 exclusion if you're single, $500,000 if you're married. And so if your capital gain is less than that, you will not have any capital gains. But if it's more, then you pay taxes on the difference. I had somebody just email me today. They had 18 out of the 24 months. And so what we told them, they're single, properties in California, huge capital gains. But because they were in it 18 months out of the 2 years, out of the 2-year requirement, that's 75%. So 75% of the capital gain exclusion is $187,500. I'm not doing it off the top of my head. I just did it this morning, so I remember. The $187,500 is what we will be using to calculate the capital gains over and above that amount that is going to be taxed. Okay. So does anybody have any questions before we go through the worksheet to look at it? Okay. So we have Nakia are still holding the property. Rehab is not yet complete. Most likely end up holding it once. Okay. So if you have a property that you bought in 2022, but it is not yet placed in service, means that it is not yet placed in service means that it is not yet what do you call it? It is not yet available for rent. Not necessarily saying that you rented it, but it is not available for rent. Then there's nothing to do in 2022. Whatever costs that you incurred up until that point is going to be added to the cost basis of the property. So in Nakia's case, even though she's still holding the property and the rehab is not complete, we're just going to update her notepad to say, hey, this is going to be a 2023 property. There's nothing to do in 2022. Because I've had a lot of people think, hey, if I bought a property in 22 and I did some rehab or incurred some expenses, can I claim it? No, if it was not placed in service or sold, you are not able to claim those expenses. You will just add it to the cost basis. Okay. All right. If you make over 200,000 this year on W-2 and buy property next year as a rental, can you deduct from this year? Let me read that again. If you make over 200K this year on W-2 from 2 jobs and buy property next year as a rental, can you deduct from this year? The answer would be no. Again, it's kind of like what I was talking about before. You can only claim that property in the year that it was placed in service. So even if you had $200,000 this year, right? But the property was not placed in service until 2023, you're not going to be able to deduct it in 2022. This would be a 2023 property. And also keep in mind what I just said, because you made over $150,000, even if you did have losses on that rental, you may not be able to claim that loss if you're not a real estate professional, meaning if you don't spend more time in real estate than you do at those other W-2 jobs, you're not going to be able to claim those expenses. Okay. I just put our website here. Anybody that wants to go, if you're not getting access to our information, then you're able to use it. So Mackenzie is asking, those losses roll over? Yes. So they are called suspended losses, and those losses are tracked on the form 8582, and they're rolled over year to year. Mackenzie, I'm so glad you brought that up. Please, 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 please. I know usually when we send you your tax returns, you don't want to be bothered. You guys treat us like dentists. You don't want, please make sure you're reviewing the tax returns. If you have a rental property and you make over 150,000, if those losses are suspended, please make sure that you are seeing the form 8582 as part of the package that you're getting, in addition to your depreciation schedule. Why am I saying this? The time comes when you want to fire me. That's fine. You can fire me. I don't care. I'm not going to be worried. I'm not going to no therapy because of you. I got other people that love me. But anyway, let's assume that you decide that you're going to go with another accountant. You want to be able to have that form 8582 that you're going to provide to them and your depreciation schedule so that they can continue on the history of that property. I can't tell you how many clients have come to us and they don't have that 8582 history, or they don't have that rental, they don't have that depreciation schedule to continue on the history. Believe it or not, we had a client this year who had $80,000 of passive activity loss, and they were not able to claim it because guess what? The accountant who prepared their return did not review their how did it happen? This did not review their 2016 and 15 return. And they had one accountant in 2015 and 16, a separate accountant in 2017. This property was sold in 2018. The $80,000 passive activity loss was in 2016. Because they only reviewed 2017, that passive activity loss was not carried over. And they ended up paying all these huge capital gains. And guess what? The statute of limitation had run on 2018. There was very little that they can do. So it's very important. I know that, yes, you want to trust us and all that, and you should, but it's trust but verify. If you're in the wealth building program, we're always trying to make sure that we educate you to make sure that you are educated, you know exactly what you have, because even if you have to go to another accountant for whatever reason, make sure that you have all your history, you know, to take with you. Okay. All right, so let's look at this calculation real quick. Merlin, get ready. After this, I'm going to give you time to come up. All right, so can you see it? Can you guys see my screen?
Yes.
Okay. So if you sold a property, this is usually the worksheet that we use. I know a lot of people are not happy when we tell them we need to do our own calculations. I cannot tell you how many times we've done this calculation and it's completely separate from the numbers that the clients are getting. So the first thing is we want to fill out this section, right? The purchase price of the property. Then you want to look at your settlement cost. Sometimes what would happen is if you have a rehab escrow that is included in the settlement cost, we need to come out and back it out here. So want to make sure we're picking up the purchase price, the settlement cost, and your rehab expenses. Then if you had holding costs or other items, like if you paid like an assignment fee or whatever, all of that needs to come in here. And this is what forms your adjusted cost basis. Then we now look at the sales price and we remove the sales closing costs to get your net sales proceeds. So the capital gain amount is what we would have as capital gain. Now, the other thing that happens is if this was a rental property, we would have to add back your depreciation that you've claimed over the years. So we would come here and we would add in the depreciation recapture. So let's say it was about $10,000. So now you're dealing with a capital gain of about 15 grand, not the 4.7 that you thought that you had. Okay. So depreciation recapture is a huge thing when you have a rental property that you sold. Okay. So I'm going to stop that. Any questions about capital gains calculations and all that before we turn this over to the Joseph Insurance Group? Tanya, you don't have any questions for me? Lorelei, Sharon, I'm calling y'all out. Angeline, Randolph, Lavon, Deanna, Charlita, Sam, Erlene, Mutsumi. Any questions for me? What if there were losses that were carried forward on the spreadsheet? Okay, I'm glad that you brought that up. So let's go back and see. So share screen. Yeah, so if we had passive activity losses, then we would come here and add on, we call it PAL, passive activity losses. So let's say it was about $18,000. So it would be 18,952. This will now impact the net amount that you have. And this brings this down now to 4,231 negative. So in addition to the regular calculation, this is mostly if you like bought a property, turned around and sold it. For a property that you're holding, we do the depreciation recapture. And if you have passive activity losses, we will pick that. So now you have a net loss of 4,231. Okay. Okay, one question is only passive losses can offset capital gains. Not only, you can also offset it with capital losses. Like if you love, but only, you know, if the overall ends up being a loss of $3 grand, more than $3 grand, capital losses is only limited to $3,000 a year. Okay. The passive activity losses, do they have to be real estate related? No, they don't have to be real estate related, but it has to be related to the activity. So you cannot take PAL losses that you have from a passive investment, like a K1, like if you're a limited partner and like in a syndication, and so you have those losses that are also being suspended because you're not active, you cannot take those losses and offset it against a property that you sold. So it's being kept in each individual bucket. However, this is when you sell. However, if you do have passive losses from a K1, but you have active passive income from rentals, you are able to net those together. So it's understanding the difference from when you sell it versus the regular income and expenses that you're picking up for the year. Okay, so right now, I can't believe we've been going for 30 minutes. So I am going to turn this over to the Joseph Insurance Group, Merlin Joseph. I asked him to come on so that we can just talk a little bit about insurance. I know a lot of people don't, we just treat insurance as, oh, this is something that I have to get or a necessary evil. But there are strategies out there to help you with handling your insurance the right way, especially if we're real estate investors. It's all kinds of insurance that we have to get out there. So Merlin, welcome, and thank you for having us. He is also a member of the Wealth Building Plan. So this is also my way of also promoting his business. So go ahead, Merlin.
Thank you. Good afternoon. My name is Merlin Joseph. Again, I'm with Joseph Insurance Group. We specialize in homeowners insurance, commercial insurance, auto insurance, life insurance, health insurance. There's various degrees of insurance we cover. This particular part is about the investors part. A lot of people are purchasing properties and they don't know which product is best assigned to their product, to their purchase. If you're thinking of purchasing a short-term investment and you're looking to say, well, what kind of insurance I need, or is it a vacant property? So there's various insurance policies that you purchase. If you know this is going to be something that you're going to flip, you're going to hold it for 6 months, you want to make sure you have insurance on it. And usually if you put it under LLC, 99% of the time, the liability portion is not covered. So that means if it's under a personal liability, you already included with the liability. But if you decide to say, listen, I want to have this as a LLC. Once you have it as a LLC, you lose the liability. You have all the other protection, but you lose the liability. That means if one of the guys doing the rehab slip and fall and land on a nail, he's able to sue you. So a lot of times, if you purchase it as an LLC, you're going to have to let the insurance guy know, hey, I need to make sure I have some liability. And you can purchase the liability as a separate item. Now,
are you saying that we would need to purchase liability insurance for the LLC, not just what we have under our name?
Right. You would have to purchase it as a separate, because once you purchase the insurance under a liability, under LLC, is considered a business product. Personal insurance covers liability. So if you purchase it as hey, this is my rental property, liability is already included in it, because they just noticed that, hey, this is a personal property. But once you have the LLC, you can say, I'm using it to rent out to people. They don't necessarily know how you're going to use it. So they make sure that you have to purchase liability, because the insurance company does not want to be sued on your behalf. So they'll tell you, okay, you need to get liability, and usually liability is $300,000, $200,000, depend on the purpose and how you're going to use it. There's various ways to purchase insurance. I can be purchasing a property and I don't have the funding. So I have 7 people invest money for me to purchase the property. Now, those people will say, well, you know what? What if that property burned down? How do I retain my return on my investment? So a lot of times we tend to put those people as lien holders, similar to like a bank. Those investors would be on that policy as lien holders, however you want to put the interest, which one is priority 1 or priority 2. Now, there's a difference when you purchase a home policy and a rental property. So if you're a landlord and you purchase a property, you have what we call fair rental value. That means if within 3 or 4 months the property burns down, you contact the insurance, they say, hey, we're going to rebuild the property for you. They're going to ask you for a copy of the lease so that you could be reimbursed 80% of your fair rental value that you lost. Now, if you're a homeowner, it's called loss of use. That means if your home is burnt down, the insurance will replace the property and they'll provide you a place to stay, and they'll also give you money for food and other expenses that you need, fuel. That's called loss of use if you're a homeowner. But if you're a landlord, it's called fair rental value. Those are the different products. So if someone says, well, I need to purchase insurance for myself, then it's loss of use. If you're renting it out, is fair rental value, and you would need a copy of the lease to get reimbursed for funding that you lost for times the house was not occupied. Now, if anyone wants me to explain to them about the different variation of discounts you're able to get. If you're purchasing a property and it's up to date in Florida, because each state is different based on the territory, the underwriters write the policies based on the territory. So if you're in Florida, we have hurricanes. If you're in California, you would have volcanoes. Earthquakes. Sorry about that, earthquakes.
Sure.
So based on whatever place you're at, the underwriters adapt to write that policy based on that territory. Now in Florida, if you purchase a home and it's 30 years or older, you're going to need a 4-point inspection. And then you need a mitigation inspection, which shows that you can get credits if you have shutters, if you have impact windows, if you have certain credits that they give you a discount for. And usually if it's an up-to-date house, if it's built after 2005, it's already in the policy, the mitigation discounts. And you don't need a 4-point inspection. But if you say my house is built 2005, you're automatically going to get those discounts. Now, some people say, well, I want a little bit more of discount. Then they'll say, well, you know what? We need pictures. We need a virtual inspection, because they're going to give you the basic discounts. Let me see what else I want to go over. Also, on your policies, there's a thing called ordinance of law. Ordinance of law means based on the time your house was built, whichever law was in place, you have to build the house up to standard. And if your policy says, okay, we built the house, but now they're telling me I need to impact windows. Originally, when I had the house, I didn't have impact windows. So now that increased based on the insurance price. Your insurance company, your policy will pay up to 25% more of what needs to be rebuilt to rebuild that property to make it up to what the law is saying that is required. Now you could purchase an extra ordinance of law, which is 50% more. But most standard policies have a 25% ordinance of law. That means based on the time the property was built, based on that time, there's been new changes because we adapt. As we get hurricanes, we change the building laws. So once the building laws are changed, your insurance policy will pay up to 25% based on those changes to the building law. So if a general contractor is building it up and saying, listen, you purchased the house for 170, it's going to cost us 280. So your insurance is only covering 200. But based on a 25% ordinance of law, your insurance will pay the extra 25% extra. Are there any questions?
Yeah, I have a question, and then Edith has a question here. If you have a question, you can post it and then or ask it, but I'll take Edith, then I'll take mine, then we'll do Sam.
No problem.
The question that Edith has is, what if the property was purchased in a trust? What kind of insurance would you need?
It would be considered under commercial. It will still, you can write it up as a trust, but the liability portion would not be in there. It was almost like an LLC.
So are you saying that we have to do a separate liability insurance for the trust?
Yes, you would have to.
Okay.
Because once you get your policy, if you look at section E, you'll notice they'll say liability 0. So you'll have to purchase a separate liability policy.
Okay. So something that has really bothered me over the years, and is nothing to you or your industry, but what really, really pisses me off is that I done paid all this money for insurance. I'm so happy that I have insurance. And then an event happens, and then I find out that I'm not covered. And they're like, oh, well, you needed to have this rider, or you should have had this addendum added, or you should have done this, that, and the third. One of my rental properties, we had a basement got flooded, and I'm thinking, oh, insurance gonna cover it. And they're like, well, you don't have a sunk pump addendum. How the heck am I supposed to know that I needed a sunk pump addendum? Why wasn't that offered to me at the time that I got the policy?
Well, once you're purchasing a policy, you have to go in detail with the agent that you're writing it with. Most agents are under the impression it's just a standard policy. You have to let them know, hey, I have a basement, or I have an extra area attic in the roof that we use as a room. So I want that covered. Sometimes, you have a structure outside. You got to let them know I have a other structure. Because sometimes when an agent writes a policy, other structures, anything inside the property that's not attached to your house, But a lot of times, an agent will say, "Oh, do you have anything in your shed?" And you're like, "No." Then he'll like, "Okay, I'm gonna remove this," because he's trying to give you the basic skeleton policy so you don't have to pay extra. But you have to let him know, "Hey, I want this covered." It's based on the rapport and the conversation you're having with the agent. You have to.
But what if you don't even know? Like I didn't even know that there was anything like a sump pump rider until this flooding happened.
The pump rider is basically something to suck out the water out your property. You have fungi, you have different things, but that's when you're having that conversation with your agent. I mean, like you're saying, you wasn't aware. I got that. But once you have, let's say, because it's not standard to say, "Look, I have a basement." So maybe in the area you're in, they usually stand to have basements, so the agent should have been well aware. So if he's not, you got to just make a mental note. "Hey, I had this situation, lesson learned. I have to make sure I let the agent know I have a basement." Now, there was a question someone wrote in regarding the rental and the LLC.
Yeah, that's from Sam. Sam says, can you revisit the liability insurance for rentals that are under personal loans and not LLC? Any considerations and any tax reduction strategies?
Okay, that's
on the tax piece, Sam, there's none. It doesn't, for us from a tax perspective, it doesn't matter whether it's personal or LLC. If it's under personal loan and not under the LLC, there's no tax reduction strategy for that. Merlin, do you have anything to say on that, where the loan is in your personal name, but it's not in an LLC?
No. I wanted to just respond to this. It says, "What's the advantage of having an umbrella policy versus a liability policy?" An umbrella policy and a liability policy is practically the same. The difference is when you use the term just a liability is usually assigned to a business. If I say I need excess liability, that means I have businesses that I need the liabilities covered. If I say I need an umbrella policy, it's usually tend to say I need this coverage extended for my home and my personal use. So it's just a terminology that's used in the industry. So if Iber was like, I need an umbrella policy, first question I would say is, how many properties do you own? How many vacant land do you have? What vehicles do you have? Do you have any recreational vehicles? To make sure everything's covered under the umbrella. And basically how the umbrella works, you have to have a basic foundation policy. The umbrella is an excess of whatever you have. So if you don't have a basic policy, the umbrella would not serve you any purpose because they would not write one. They want to make sure you have a standard of 300,000. And then once that's exhausted, then your umbrella kicks in. Now, there's another question. Are there any difference between an insurance policy for a single family home and condo? Yeah, they're different. Single family home and condos are different because when you purchase a single family home and your insurance goes out, that single family home, the coverage covers everything on that land. When you have a condo policy, the condo policy, they usually have a master policy. Your condo policy covers everything between the walls of the inside and around. The common areas are covered by the master policy. The association controls that master policy. So if you had a hurricane and the inside of your wall was torn out, your condo would cover that. It would cover the ceiling. Everything is attached to the walls, your cabinets. But anything outside of that, the master policy of the association has to cover that. So if we have a common area, that is not your responsibility. That is the master policy. Now, anything inside your toilet, your cabinets, that's where your condo insurance will cover, your interior items.
All right, let me take this next from Eddie, and then we
Yes.
continue on. So one of my clients stated that whenever you're getting insurance, always ask what kind of riders are available to you on this policy. So that's a standard question that you want to start asking so that you're not caught with your pants down like me with the property that now you're thinking insurance will cover and it ended up not covering. So Eddie's question is being familiar with life insurance and how it can be used to fund real estate. The one that I know is the maximum funded life insurance policy. So it kind of works with under like an IUL, but it's maximum funded. So the way that I'll explain it from my perspective because I have it, and then I'll let Merlin explain it from here. So the way that it works is, let's say you have a $650,000 policy, and maybe 30,000 is what gets you the term, but then 80,000 is what gets you the universal life. You are able to maximum fund it, which means that you can pay it off in the first 6 years and you're done. By paying it off in the first 6 years, I think you don't have to make any other payments for 13 years. That starts building value, the cash surrender value and the policy. And then what happens is that if you do it when you're really, really young, and so you're not going to need it anytime soon, if you get into an emergency situation, you're able to go and borrow against the cash surrender value that you have in the policy, and you have about 5 years to pay it down, and it's at a very low interest rate, like 3%, 4% is what you're having to pay back your insurance policy. So I have that work for me a lot of times because one, get the insurance while you're younger, front load it, that's why you do the maximum funded, allow the cash surrender value grow, and then now you can take out a loan against the cash surrender value and use it to purchase, whether it's real estate. For me, I usually use it for my kids and their school, use it to fund their school. And if you take like 3-4 years to pay it back, you still have that insurance rider. Actually, what I'm doing, the extra thing that I'm adding to my insurance policy is being able to add it so that by the time I turn 55, I'm able to start getting withdrawals from it, and it's tax-free. So this is tax-free income from your insurance rider. It brings down the value of the insurance policy that you have, but you're able to use it for yourself. And the goal is that with your spouse and with your kids, that you would have built up enough assets that they may not necessarily need that insurance, and you're able to use it for yourself, right now. So I'll let Merlin talk about from your perspective, and then we'll take additional questions.
Well, with that particular question, usually I have a daughter who handles that part of the insurance because I usually deal with most of the property insurance. She does a lot with the life insurance part aspect of it. So I couldn't go in detail with that. Usually I would refer Eddie Colson. What I can do is I can give you my daughter's information, and she could in detail discuss it with you, because that's an area where I just usually send that to her because she specializes in that part of it. Now I have sorry about that, Eddie, but with Miss Adams, it says if I have a rental in my name, but also have an LLC entity, I'm covered for liability. Do I need a separate policy? You will need a separate policy because the LLC is under a company. Now the rental is under your name. So you're saying you have two separate, I don't know if I'm understanding it right. If you're saying I have one property under my name and one under LLC, there's two separate properties. The one under your name will have the liability coverage, but the LLC, you will have to purchase liability for it. The next one is from Miss Mary. It says, what insurance should I have on vacant land? On vacant land, there's a policy you can get. It's an annual policy. Or if you already have insurance, you could get umbrella coverage to cover your vacant land. Usually depends on which states. In some states, once you purchase a property, your insurance have an extension that will cover any vacant land you have. You just would have to talk to your insurance guy, whoever your insurance guy, because in some states, now in Florida, you would have to purchase umbrella coverage to cover anything outside of your personal home. The other question I have is,
I think that's Stacy Adams.
Stacy Adams, yes. I'm in search of new insurance options for my primary, which I may rent out in 2024. What is the best way to compare insurance, comparing offering? Now, I don't know what state she's in, but in Florida, they have a website.
New York.
That you base, oh, you're in New York. So I'm not familiar with that, but I know in Florida, you basically put your information in and they list all the insurance companies so that you can see and you could get your own rating right off of that. I'm looking to purchase a Florida rental in my out-of-state LLC and retirement account. Do I need separate policy to cover that? Rental. Out of state LLC retirement account. I'm not unclear about
So
what.
what she's saying is that she's gonna purchase a Florida rental
Uh-huh.
and her LLC and her retirement account are purchasing it together. So the retirement account has a percentage, let's say 50%, and her LLC has 50%. Does she need one policy for the LLC piece and then another policy for the retirement piece? Or does she just need to cover the rental property itself, not necessarily the owners?
No, it depends on how the finances worked out. So if she has one part as a lien holder, then she would just have to, she would purchase it, but she would just attach as a lien holder. If the retirement is the lien holder, she would put that down. But if she says, I don't have a lien holder, it's just two finance pieces coming together to purchase it. Then whatever name she has, that's what we're gonna put it under. So I want to know about it.
All right, so Eddie, I also wanted to know how it would work as creative finance deals. We covered sub to and a trust, but what about when it's a lease option and we're not on title yet, but a tenant with an option to buy? How do we get insured to protect our interest? I think it's limited to just tenant insurance, right? I mean, if all you have is the lease, you really can't, unless there's a clause there that you have some action triggers the option to buy contract. I think you're just limited to the tenant insurance, right?
It's a renter's insurance, but you just put as a lien holder.
Yeah.
So if they default, that you would be in contact.
All right, can you borrow from a liability insurance policy? No, there has to be a cash surrender value for you. So you can't do it with the liability insurance. You can do it with a life insurance. You can't even do it with term. And there's something where you can't even do it with a whole. It has to be one that has a cash surrender value.
Anyway, a liability, just as the term it says, is to prevent lawsuits. If you slip and fall, that's the basis of it. So if you slip and fall, and I try to always tell people who are landlords and they're renting out the properties to make sure that the person who they're renting out has renter's insurance, because it has a liability piece to it. So that if I purchase from you and I invite two friends and they get in a fight, so that you don't wind up being sued. So if I have a renter's insurance, the liability piece is going to cover that part. And also the liability piece covers you if somebody has a car accident and they're renting from you and they don't have any car insurance. That liability part covers them. It's an extension if they have that renter's insurance, because if not, they're probably going to go after the property owner.
All right, can you put your information on the web, on the chat for those who want information about you? Laurie's asking if you have that Florida website to compare policies. I'm sure you can also reach out to Merlin and he can assist. That's the business. That's what they do all day long. Twyla, yes, we have it recorded and we will be sending it out. Okay, so we have about a few minutes. Any other last questions before we finish out now with taxes? Getting back to our year-end strategies. Okay, so Jason is asking, do you actually look at the policies your clients already have and educate them on better options? I think this is a really good question.
Yes.
Like, do you review policies and help them come up with a better strategy to protect themselves?
Yeah, well, we are an independent insurance agency. So what we do a comparative analysis every year for our clients to let them know, okay, here's a better product. So we look at it and say, based on price, we can match it apple to apple. So let's say your renewal comes up and we got two new companies and we notice the price are competitive. We'll say, okay, here. And usually what we do, especially during the hurricane season, we tend to discuss certain things to make sure a list of things that our clients have on hand, to make sure based on that, a list of emergency contacts, a list of items that they need for emergency use. So we do that on a regular basis because that's how we retain our clients, to educate them.
All right, so please include your information there. Thank you so much. Wasn't this good? Can we give a high thumbs up and thank you to Merlin for this presentation. This has been very informative. So the main thing that I wanted to end up with is our advanced strategies. We talked about like the oil and gas. The reason why I love the oil and gas investment is that if you invest in oil and gas, it's a 1-to-1 ratio. Like if you invest 50,000, you potentially could claim up to $50,000 deduction. Nevertheless, you need to have the $50,000 to invest to be able to get the tax deduction. You can do a 1031 into a large established investment property. You can do the qualified opportunity zone fund. You can use a charitable structure to take advantage of using itemized deduction. So these are just little things that you can do. For 2022, let's see what we have here. Yeah, so you can use the leverage charitable deductions, structured ownership program, gas and oil and gas, solar panel strategy is no longer available, will be available in 2023. So there's a lot of things that you can do before year end to reduce your taxes. That's what we're currently doing for clients right now. You know, you can set up a solo 401k if you have earned income from your business. And oh, that's very important. So let me tell you guys a little bit about how the solo 401k works. A solo 401k is a business 401k, right? It's a business 401k. So if you have that, then you are able to contribute into that account, and you can do up to $63,000. But what I love about the solo 401k is that it has two components. It has the profit sharing component, and then it has the salary deferral component. So let's say you have a regular job and you can do up to $2,500 at your regular job, but you only did $10,000. That means you have an additional $10,500 that you can contribute to your retirement account. If you have earned income from the business, you are able to do $10,500 as a salary deferral, plus the profit sharing, which can be up to 25% that you can do. So setting up the solo 401k is a very good strategy for those that have active business income. Now with the solo 401k, you do not have to fund it by December 31st. You do have to have the account set up by December 31st, but you can fund it up to tax time, including extensions. This is a great strategy because guess what? You set up the solo 401k by 12/31, you have up till September, a whole 9 months into the following year to contribute and still get a deduction on your current year taxes. So that's why we love that strategy a lot. A lot of our clients use it. We charge $9.95 to set up the solo 401k, and that's because we're doing the self-directed 401k, but you can set up a solo 401k all day long with a brokerage 401k. The brokerage 401k is free. The only thing is that you have to invest in one of their products. But if you wanted a self-directed 401k, we can set that up. That's $9.95. Okay, so I have a couple of questions here. Is it prudent to have multiple 401ks if you have multiple companies? Not really, and I'm glad that you brought up that question because your contribution has to be looked at in total. I don't care if you have 50 companies out there, 50 jobs out there, the maximum that you can contribute to your salary deferral is $2,500 or $27,500 if you're over 50. The maximum that you can contribute for the salary deferral portion is the $32,000. So when you're looking at retirement accounts, you are looking at it in total. So it doesn't matter how many you have out there. You cannot say, oh, I'm gonna do 63,000 in this company, I'm gonna do, no, all together, you can do it. Now you can set up a defined benefit plan where you can do up to $120,000, $150,000, but it's something that you would need to set up and also ensure that you're able to do that every year. So there is possibility of having other retirement accounts where you're able to do more, but it's not the solo, those are more of the defined benefit plans. Okay, we're coming down the pike here. Can you set up a solo 401k if the business is a multi-member LLC? Yes. And also if you have a self-directed IRA and a TSP, yes, you can. I'm glad you brought that up. There's a difference between a self-directed IRA and a self-directed 401k, okay? IRAs have custodians, you need permission. You have to put in the money with the IRA company. Solo 401ks are business 401ks. You can set it up with your regular bank account. sorry, you can set up at your regular bank where you have your regular business bank account. You don't need a custodian. You're not having to deal with UBTI taxes. The fees that you have to pay, like we charge the $9.95, every year it's $125. With the self-directed IRA, they charge you based off of the value that is in the account at the end of the year. But yes, you are able to set up a solo 401k. You can also have a self-directed IRA. You can have a TSP. But again, you have to look at everything in totality when we're coming to do new contributions. You can roll over an existing traditional IRA or if you have a job and you left that job, your pension, you can roll over from that into a 401k, but you cannot roll over Roth IRA into a Roth 401k. Roth 401k only accepts new Roth contributions. Okay. Can you reach out to me so we can further discuss the oil and gas strategy? I am going to provide our email address here. Please feel free to send us an email and then we will take it from there. If you do not have a business, can you open a solo 401k? Yes and no. Yes, in the sense that you can, like you can open one that's like a what do you call it? A sole proprietor 401k. So you're free to do that all day long, but you are only able to roll over an existing IRA funds, but you cannot make new contributions to it. New contributions to a solo 401k is based off of having business earnings and not just having like rental, like you can't do rental income except we pay you a management fee. So you have to have active earned business income to contribute new money into the 401k, but you can roll over existing IRA funds into the 401k. That's another way to even get started in real estate. If you have money from your former job that's just sitting there, not really growing, you can roll it over into a solo 401k and then purchase, real estate from that. Okay. Any other questions, tax related questions, year-end strategies, anything? I'm going to post our website again. If you need to reach out to us, we have a lot of articles on there that you can also read to help you with your year-end strategy. Any other questions? The solar is going to be available again in 2023. If you're interested, please feel free to reach out to me and we will get you on the list. We're currently starting a waiting list for the 2023 deadline. The deadline for a session, if you're in the wealth building program, it will be next week. By the 21st, you should have talked to me because after that, hey, I'm on vacation, but you have up. So if you're here and because I see a lot of you, if you're in the wealth building program, but then have time to get us your documents, still go ahead and schedule a session so that even if we're not able to run your numbers for you, we're able to have a conversation. If you're not in the wealth building program and you wanted to take advantage of our year-end tax planning, you can still schedule a meeting. As long as I have a copy of your return, you're able to tell me your significant life events. I'll be able to tell you over the phone some scenarios that you can implement before year end. Okay.
I have a question as it comes to the insurance piece. So if I put my property in an LLC and I already have some insurance on that property, and I think it's homeowners or it's a condo, and it's probably what the gentleman was talking about. But do I get rid of that and just go with what do you call it?
The one in the LLC?
No, what I'm saying is, should that insurance go away if it goes in an LLC and I get liability insurance, or do you keep both of them depending on your situation?
All right, Merlin, are you able to answer that? So if you have insurance when the property was in your name, now you've moved the property into an LLC, do you keep that insurance policy that you had in your name, or does it automatically go away because you now put it in an LLC? Now you have to get a new policy.
Correct. I mean, maybe not automatically go away, but is there a need for it? And I know that's on a case-to-case basis, but
okay, Merlin, you need to unmute yourself. There you go.
The deed will have the LLC, so the insurance will have to reflect whatever's on the deed. So if it's still under your name and there's something happened, they're not gonna honor it because that's not what's reflective on the deed or the title or the paperwork. So once you change it, it would be in your best interest to make sure they match. To say, you know
Okay.
what, let me make sure the paperwork match, because if there's a fire and you go to make a claim, they're gonna say, well, this is under Jack Daniels and this is under LLC, it's two different things.
Okay. Did you put your contact information in there or?
Yes, I did. I'll do it again. Let me go again. I'm doing it right now again.
All right.
Sorry, I was talking and I was muted. Yeah, send it to everybody, Merlin, so everybody can have it. The profit first accounting strategy, we don't necessarily implement it for our clients because it's more of a facts and circumstances stuff. However, do I believe that business owners need to pay themselves first? Yes. But there's some situations, it's something that you need to consider on a year-by-year basis, depending on how the business has performed for the year. So I do believe that you need to be putting away, no matter how small, money into your retirement account. You need to be setting aside some funds for yourself before you pay the business expenses. However, depending on how the business is going, like a lot of people are hurting, now they're having to hold on to the properties a lot longer. You're not going to say, oh, I'm going to pay myself and then not pay your holding cost, So for me, that's a fact and circumstances issue. It's not a one size fits all. It's something that you would need to review based on what's going on to be able to decide what's the best way to go. Marlene, we still don't see your information. Did you send it individually? I'm also trying to see if I can.
I sent it in the chat. You don't see it in the chat?
Nope, it's not in the chat. But
Yeah.
I'm pulling it, and I'm sending it to everybody right now. So I have that, and let me see if I can pull your phone number.
You don't see it?
Nope. But it's okay. I got all of you here. So let me copy this, and I'm putting this for everybody to pick it up. Okay, so this is Merlin's information. I have his phone number, I have his address. You pretty much can hunt him down, his fax number. The only thing I didn't put there was his social security and credit card number, but you have everything there to be able to reach him.
Thank you.
All righty, guys, you have been wonderful guests to our year-end program. Please, everything that we discussed is not a one size fits all. We've given you general things, but I encourage you to try to get your own personalized tax reduction year-end strategies. We'll let you know the cost when you call us. For those in the wealth building program, it is complimentary. Even if you didn't send in your documents, still go ahead and get this scheduled. So I will go ahead and stop the recording.